you exactly what this is. You have non-commercials. Those are professional commodity trading advisors, hedge fund managers, people that are using the futures as a hedge or speculative investment. Now, they may be in Forex. Maybe they're hedging their position in the futures. Or if they're what we call a CTA or a managed fund, they're using the futures to speculate. Once again, they're the smart money, and they're also the deep-pocketed smart money speculators. Non-commercials. That's what they're considered. The commercials are the banks, the institutions, or multi-international conglomerate corporations who are looking to hedge their risk. They know that in the next 3 months, I'm going to have to convert US dollars to euro currency, and I don't want the valuations to change. I know what it cost me today. I can work that into my business model, and I can see an answer to my shareholders at the end of the quarter that we did not take a loss on conversion. We sold a lot of product overseas, but man, when we took our profit home, we got killed on that conversion rate. So what will happen is commercials will enter in the market, and that is represented by this figure here. Now, what they do is they take what we call the open interest. The open interest is the overall contracts, either long or short, and that's also in your trading guide, by the way. And they determine between the professionals who have reportable positions and the commercials who have reportable positions. They take those figures, subtract it from the total open interest number, and they figure out that the little guy, the non-reportable position category, that's the individual speculator who might be in 1 or 2 or 10 contracts, not certainly 200 or 300 contracts, right? They distinguish what their position is. The next line, we see, of course, long, short, how many are spreading, long, short, long, short, long, short. Okay, real good. Look at this non-reportable, the small speculators. In this situation, the British pound and the Commitment of Traders report comes out on every Tuesday. So as of 5/10, which was a Tuesday, if you go back and look at your calendar, 5/10 of 05 was a Tuesday. Now, if you move forward, it's released on Friday afternoon at 2:30. Well, here's the thing. You've got to distinguish what happened from Tuesday to Friday. That's the key with using Commitment of Traders report. And if there is no big change, and if the market was in a big run-up in the market, and prices were advancing, and I see that these guys are long 2-to-1 contracts, if I see the banks and the institutions are short, and if I see the commercials, look at the non-commercials, I mean, the professional speculators, they're long 5-to-1. They're long 25,000, they're short 5,000. That's a 5-to-1 ratio. 22-to-12 is almost a 2-to-1 ratio. That means all the speculators are net long, the banks are net short. Do you see that? Here, long 40,000, short 70,000. That's how you read that. To me, I would say if I were long, I'm getting nervous. Or I'm looking for, if I have sell signals like a low closed doji, if I have bearish divergence, I'm going to probably take the advice or the opinion that I can look for selling, or I want to stay on the short side and look for selling opportunities. I don't want to buy breaks. That's how you can use this information for longer term trading. Well, let's take a look at this. By the way, right here, this arrow, that was as of Tuesday. That was what was going on in the market. There are Wednesday, Thursday, and Friday. So again, this is what the market was showing us. What was going to have happened. And sure enough, the market went down like a rock. Now, again, this is the 10th, as you see on your screen. So we know that if that's Tuesday, that's Wednesday, that's Thursday, that's Friday. Did the market conditions change? From Tuesday's close at 188.27 to Friday when we got the information, the market dropped 327 pips on a British pound. I'd have to tell you something. I don't think the public or those professional speculators are still long the market. So you can determine how to use this information and determine what the strength or weakness of the trend is and whose hands is in control of the market. This is for just identifying the trade. You only have to do this once a week. If you're only trading 2 or 3 Forex markets, it's not a lot of work. Once you identify how to look at the information, whose hands does the market is